In 2008, the entire global economy came within inches of collapse. Trillions of dollars vanished. Millions of people lost their homes. Entire countries went into crisis. And at the center of it all was one bank. A bank so deeply connected, so dangerously exposed, that when it fell, it almost took the entire world with it. To understand how this happened, you have to go back to a time where everything looked perfect. The early 2000s felt like a golden era. The stock market was rising. Housing prices were exploding. Banks were making more money than ever. And for everyday people, it felt like wealth was easy. Buy a house, watch it go up in value, repeat. But behind the scenes, something far more dangerous was building. Banks weren't lending money anymore. And no one did this more aggressively than Lehman Brothers. Lehman wasn't just participating in the system, they were pushing it to the edge. Lehman Brothers had been around for over 150 years. They survived wars, depressions, market crashes. They were considered untouchable. But in the early 2000s, they made a decision that would change everything. They went all in on housing. Here's what that means in simple terms. Banks were giving out mortgages to people, even people who couldn't really afford them. These were called subprime loans, risky, fragile, unstable. But instead of worrying about that risk, Lehman saw opportunity. They bundled thousands of these mortgages together, turned them into financial products, and sold them to investors around the world. On paper, it looked genius. They were making billions, but underneath, crashed. And suddenly, millions of homeowners couldn't pay their mortgages. That's when everything started to unravel. Those bundled investments Lehman sold, they began losing value fast. And because Lehman had invested heavily in them themselves, they weren't just selling the risk, they owned it. Billions turned into losses, losses turned into panic, and panic turned into something much worse. By 2008, Lehman Brothers was in serious trouble. They were drowning in bad assets. Investors were pulling out. Confidence was collapsing. But here's where things get critical. Lehman wasn't just any bank. They were deeply connected to the entire financial system. Other banks relied on them. Markets depended on them. Global money flowed through them. So when rumors spread that Lehman might fail, fear spread everywhere. Because if Lehman collapsed, who would be next? In September 2008, it finally happened. Lehman Brothers filed for bankruptcy, and overnight, everything changed.
Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Two-year note yields went from 190 to 166 in the blink of an eye.
On the NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
From the financial capital of the world, the opening bell is going to ring in 5 seconds, and to be honest with you, we wish it wouldn't.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on the Dow, not so focused on OPEC. Yes, OPEC did cut production by 1.5 million barrels per day.
Really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
And we're not getting the bid wanted. We're not getting the stop trading, and we see where the buyers are. We're just, every day they're pounding it.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Can't look at it after you buy it. It's so horrible.
But we've had an 8-day losing streak in the Dow that in percentage terms puts it on par
close to the loss suffered in that crash in 1987, close to that percentage loss those 2 days in 1929.
What started in America last year has now spread to every part of the world.
We're down 9% today. The Xetra DAX over in Frankfurt is down by 9%. The Paris market down by 9%. Austria, which was briefly suspended earlier on in the day, is down by nearly 11%.
This market is as volatile as you'll ever see.
Traders saying this is the craziest day they have ever seen in these markets. Veteran traders saying they've never seen anything like it. The movement in oil prices so fast, so fast.
Seconds to go until the start of trading at the New York Stock Exchange, and stocks are set to kick off lower, a whole lot lower.
eBay is down 6.5%. And really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure. Yahoo down 8.5%. Cisco 6.5%. Research in Motion 10%.
This could be the most serious recession in decades. And that means life, as most Americans know it, is about to change, in some cases dramatically.
So how does something like this even happen? How does one bank get so powerful, so exposed, that its failure threatens the entire world? The answer isn't just finance, it's psychology. Because at the core of this story is one dangerous idea. It will keep going up. That belief drove everything. Banks believed housing will always rise. Investors believed the system was safe. Home buyers believed they couldn't lose. And when everyone believes the same thing, no one questions the risk. Lehman didn't think they were being reckless. They thought they were being smart. They followed the money. They followed the trend. They followed the crowd. And that's exactly what made it dangerous. Because financial bubbles don't feel like bubbles while you're inside them. They feel like opportunity.
Lehman Brothers is going bankrupt, and financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black. Employees of America's fourth largest investment bank saw the writing on the wall late Sunday after talks to pull them back from the abyss collapsed. British firm Barclays Bank said no thanks, while Bank of America decided instead to help another struggling bank, Merrill Lynch, in a merger deal worth over $50 billion. The U.S. government said it won't bail out Lehman, which last week announced more than $3.9 billion in losses. Shares in Lehman Brothers have plummeted more than 80% in 2008 alone.
Lehman, like so many other investment banks and banks, really got, quite frankly, caught up in the housing bubble. But like every bubble, the bubble ended, and now we're seeing the downside of that bubble.
Following the same risky practices that sunk former giants Fannie Mae and Freddie Mac, Lehman also had a hand in securing America's high-risk subprime mortgages, believing that the popularity and sheer volume of those loans would net huge gains. But it didn't. Borrowers saturated the U.S. housing market, taking on enormous mortgages in spite of poor credit history. As the economy cooled, Americans found themselves with less cash to spend. Higher fuel prices did not help. The result was that more Americans began missing their monthly mortgage payments. As Lehman Brothers secured many of those mortgages, the result was more than $60 billion in losses. Lehman Brothers now go to court, where a judge will take control of the bank until its assets are sold. The implications could be profound.
Everybody in the West, at least, owns, a lot of people have got pensions, and these pensions invest in stock market, and a lot of the shares are actually the shares of banks. And when bank shares get hammered, people's pensions get hammered, so everybody loses. When big banks like Lehman go under, the housing market is going to suffer again. House prices are going to fall in America and Britain, in Europe and so on. That's going to again hit millions of ordinary people.
Meanwhile, as markets everywhere react, the bottom to America's financial woes appear nowhere in sight. 10 of the world's biggest banks have set up a $70 billion emergency fund to help stabilize the market, and they may need it. Reports that American insurance giant AIG is also seeking a U.S. government bailout will only compound Lehman's fallout. Monday will be a difficult day to face for Lehman's thousands of shareholders and more than 25,000 employees. Many had hoped this day would never come.
This is going to be one of the watershed days in financial markets history.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend. Lehman Brothers, a 158-year-old firm, filed for bankruptcy.
I don't think anyone really expected a bank as big as Lehman to be in a position that it's in now.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
I'm starting to find another job.
Meanwhile, Merrill Lynch, fearing it could be next, agreed in an act of desperation to a shotgun marriage with Bank of America. Merrill, the country's biggest brokerage with 60,000 employees, had been battered by nearly $50 billion in mortgage-related losses.
It is definitely a very, very difficult time, and it's not going to get better quickly.
So in just 6 months, 3 of the 5 biggest independent firms on Wall Street have now disappeared. Bear Stearns, which collapsed last spring, Lehman Brothers, and Merrill Lynch. Treasury Secretary Henry Paulson tried to reassure investors today.
The American people can remain confident in the soundness and the resilience of our financial system.
Paulson attempted to broker a deal to sell Lehman over the weekend, but unlike the buyout deal for Bear Stearns, the government would not offer any financial guarantees.
I never once considered that it was appropriate to put taxpayer money on the line in resolving Lehman Brothers.
It would have required an $85 billion subsidy to keep afloat. Overall, I estimate it's going to cost at least $400 billion if you wanted to bail out the whole bunch. They're certainly not worth it. It's better to let them fail.
Insurance giant AIG is the next name on the list of troubled companies. It's looking for $40 billion in bridge loans.
Some people say this doesn't stop until the housing hits bottom. You think that's true?
I think that's probably correct.
Veteran trader Art Cashin believes there could be more casualties.
This is the 5th time we've seen this movie. And you sit on the edge of your seat and you yell at whichever character it is, don't go into that woodshed. But they keep going in.
The Federal Reserve meets tomorrow. The expectation before the events of this past weekend was that the Fed would sit tight on interest rates. But now some are actually forecasting another Fed rate cut tomorrow. Katie?
And Anthony, I know individual investors don't have their money in Lehman Brothers. It's those big corporate institutions that are most directly impacted by the bankruptcy. So what will happen to the assets that are left?
Yeah, Lehman, Katie, actually has $600 billion worth of assets. Some of those profitable ones, and there are some, will get sold off. The others will get divided up in bankruptcy court, and that could take years. It's important to note here, Katie, that one reason the Fed and the Treasury did not inject government money in a deal to try to save Lehman was that they thought many of their clients had time to anticipate all this. Katie?
All right, Anthony Mason on Wall Street. Anthony, thank you.
There's another key lesson here. Complexity hides risk. Those mortgage-backed investments, most people didn't fully understand them. Even professionals struggled to see the real danger. But because they were complicated, they were trusted. And that's a pattern you still see today. If something sounds sophisticated, people assume it's safe. But complexity doesn't remove risk. It often hides it. And finally, there's the issue of interconnected systems. Lehman didn't collapse in isolation. It triggered a chain reaction. Banks lending to banks, funds tied to funds, markets tied to everything. When one piece broke, everything started shaking. Lehman Brothers didn't just fail as a bank. It exposed a flaw in the entire financial system, a system built on confidence, trust, and belief. Because when those things disappear, even the biggest institutions can fall overnight. The right warning here isn't about one bank. It's about human behavior, greed, overconfidence, following the crowd. These are the forces that build bubbles and destroy them. Because the next financial crisis, it won't look exactly like 2008, but the psychology behind it will be exactly the same. And if you want to understand how money, power, and deception keep shaping the world, there's always another story waiting, one that most people never see coming.